Jim, it's great to have you. As I did my research on you, the heavyweights in the political arena, journalists from all over America, you're a bit of a go-to guy in the economy. Obviously, you're one of the wisest men out there in the economy for the USA. So we're so thrilled to have you on the program. You're a whale in the industry. Now, Jim, I'd like you to give us some opening comments before Harry will come on and give some opening comments, and then we'll go into the debate. So, Jim, over to you.
Great. Thanks for that introduction, Greg, and great to be with you and great to be with Harry. Anyone who's followed either one of us may know that Harry and I had a very high-profile debate about 6 or 7 years ago, and John Malden, very well-known commentator, was the moderator. The funny thing is, a lot's happened in the last 6 or 7 years, but in some ways, we're debating the same topic, which is inflation versus deflation, or how that affects the price of gold. And Harry, went through a number of very large, potential changes and meltdowns and crashes, et cetera, involving equities and real estate. And, you can pick your spot. There was a lot there. But fortunately, tonight we're going to be, or this morning in Australia, we're going to be able to focus on gold because that's our specific topic tonight. And Harry has a forecast that gold's going to go to $1,000 an ounce. My forecast is $10,000 an ounce. So there's a pretty big spread, pretty big difference. You can pick your side of that. And I want to kind of go through the analysis. By the way, I should make it clear, I'm not in the mutual fund sales business. I'm not in the gold sales business. I talk favorably about gold. Frequently, people say, well, you're just talking your position. You're trying to sell us some gold. Actually, no, I'm not a dealer. If you want to buy gold, be my guest. If not, that's up to you. I just try to do the analysis, look at the fundamentals, look at the technicals, and write about that and talk about that and kind of keep it at that analytical level. I'm not out to sell anybody any gold. But I'd like to just point a couple of factors. Number one, for the last several years, until very recently, Harry had a forecast that gold was going to go to $800 an ounce. Today, he's at $1,000 an ounce, and that's fine. You get new facts and information, you should revise your forecast. But I just think it's interesting that Harry's gold target has gone up 25%. In the last couple of years. So we're still a huge spread between 1,000 and 10,000, but I think Harry's coming my way a little bit. I'll just give a little more time. So let me look at three main drivers of the gold price, three things that would indicate that the price of gold is going a lot higher and getting to the $10,000 an ounce I described. The first one is technical. So we're in the third great gold bull market in history. And you say, well, where's the history? It goes back, 7,000 years. How come it's only the third bull market? Well, the answer is that until 1971, gold was just money. You didn't have to say, what's the ratio or what's the price. It was a form of money. The IMF took subscriptions in gold. Gold was in the reserve positions of major central banks. So it wasn't until 1971 when President Nixon broke the last link between gold and I'll call it paper money or fiat currency, that the price of gold could fluctuate enough that you could have a so-called bull and bear market. So I start from 1971. So we had a bull market 9 years, from 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That was a 2,100% gain in 9 years. Then it was flattish, trending down for a very long period of time, almost 20 years in the 80s and 90s. Finally hit bottom at $250 an ounce in 1999. That's when the second great bull market began. And from 1999 to 2011, gold went from $250 an ounce to $1,900 per ounce. That's a 670% increase over 12 years. Then a very sharp bear market from 2011 to 2015. The price of gold collapsed over 50%, just about 50% for a round number. And then you can pick the exact day. I'll tell you the day, December 16th, 2015. That was the bottom of the bear market and the beginning of the third great bull market. And we're in that bull market today. The price of gold, it peaked, interim peak recently, August 8th, 2020. It hit $2,060 an ounce. That was more than double, or just about double, from the end of the last bear market, the beginning of the new bull market. It's backed off a little bit since then, about down around $1,800 an ounce, give or take. Obviously, a lot of volatility, but that's normal volatility and fluctuation in an extended bull market, which is what we're seeing right now, where the price of gold has doubled. But where is that going to go? So what I did, if you take those numbers, first bull market, 9 years, 2,100%. Second bull market, 12 years, 670%. Just take a simple average of the two. You don't have to pick the higher of the two. You don't have to assume it'll be bigger or longer. It could be, by the way, but just take a simple average of the two. That would come to a 10-year bull market where gold goes up 1,385%. So that would put gold at $14,500 an ounce in 2025. So there's one way of analysis, a technical analysis. But if the current bull market is simply the average of the prior two, not bigger, not better necessarily, just the average of the two, gold's going to hit $14,500 an ounce in 2025. So let's flip to another mode of analysis. And Greg, you were right in previewing this, that there were mathematical basis for what I'm saying. I don't just pick a number and throw it out there and say, oh, gold's going to go here, or up or down. There's, as I say, very rigorous mathematical analysis behind all of it. The second mode, one way to think about it, what if you had a gold standard? Now, I'm not saying we're going to have a gold standard. There is not a central banker in the world that wants a gold standard. I can assure you that. But they may have to go to one. There's a loss of confidence in the dollar. And by the way, we're not going to live in a world where the dollar crashes and everyone says, "Get me some euros." I mean, that's nonsense. If there's a loss of confidence in paper currencies, such as the dollar, starting with the dollar, that loss of confidence is going to apply to all paper currencies. It's not going to be one. The only thing that's going to go up in that world is gold, because gold is not a fiat currency. It is a form of money, but it's not a fiat currency. So the idea that the dollar is going to crash 50%, the euro is going to go up, that's ridiculous, because if you double the euro, it's going to kill European exports. They're not going to sell very many Airbuses or Airbus planes or bottles of French wine, et cetera. So major currencies trade in a range. Yeah, they can go higher or lower, but they trade in a range. They don't go to zero like Hertz. They don't go to the moon like Apple. They fluctuate in a range. That will continue to happen. If you're a currency trader, an exporter, yeah, you care about that. But if you're looking at what is sometimes called the Great Reset or monetary collapse, it's going to affect all currencies at once. And at that point, central banks may have to go to a gold standard to restore confidence. Now, people say, well, there's not enough gold in the world. Maybe once upon a time there was enough gold to support commerce, but there's not enough gold today. Numbers are so much greater, GDP so much greater, commerce, trade, foreign exchange trading, et cetera. Sorry, there's not enough gold. Well, that's nonsense. There's always enough gold. It's not about the quantity of gold, it's about the price. So what you have to ask yourself, what is the implied non-deflationary price of gold in a new gold standard, or even an approximation of a gold standard where you were trying to restore confidence? Well, the way to do that, again, the good part of this is the math is also a seventh grade math. We don't need integral calculus for this. The global M1 money supply today, when I say global, I mean United States, ECB, UK, Canada, Australia, China, and Japan, the major economies, in other words, which is the vast majority of all the money supply. The M1 money supply is about 32.3 trillion, approximately. Now, the amount of gold, official gold, we know that number is 34,000 metric tons. So again, this is all publicly available information, none of it's secret. So you got 32.3 trillion of M1 money supply, 34,000 metric tons of gold. How much gold backing do we need to support the money supply? Now, this is a subjective judgment. I don't think there's a definite number. I'm using 40%. The Austrian economists and monetarists will bang the table and say, it's got to be 100%, or else you have what they call fractional reserve banking. But historically, gold standards have worked well with 20% backing. That's what the Bank of England had throughout the 1800s, rather, the 19th century. So I'm going to use 40% as a conservative assumption, but that's high relative to most historical gold standards that have worked. So The math is simple. Basically, you take 32.3 trillion, you need 40% of that, which comes to 12.9 trillion. So you need $12.9 trillion worth of gold. You have 34,000 tons. So what's the price per ounce for 34,000 tons to get to 12.99 trillion? Well, the answer is $12,000 an ounce. So take your 34,000 metric tons and do $12,000 per troy ounce, and that comes to 13.2 trillion, which is more than enough to get you to a 40% level on 32.3 trillion. So that's called the implied non-deflationary price of gold in either a gold standard or a shadow gold standard, is some way that central banks are looking to restore confidence in the paper money. So that gets you to $12,000 an ounce. The third method has to do with confidence, specifically confidence in the dollar. Right now, the US debt to GDP ratio is about 130%. So take the national debt, divide it by GDP. What's that number? Well, the answer is it's 130%. Debt is about $32 trillion and GDP is about $24 trillion. There's very good evidence that, a ton of research, empirical data that says when your debt to GDP ratio is above 90%, the Keynesian multiplier drops below 1. What that means is, the Keynesian multiplier says if you borrow $1 and spend $1, you can get $1.20 of GDP or $1.30 of GDP because the dollar, you pay me the dollar, I pay somebody else, they pay somebody else. There's turnover and velocity, and you get slightly more GDP. And that works well. A 30% debt to GDP ratio is considered very comfortable and sustainable. 60% is a little high. That's where Angela Merkel, gets nervous. 90%, you're through the looking glass. Well, the US is at 130%. That means we cannot borrow our way out of a debt crisis. So you just can't do it. In fact, the more you borrow, the worse it gets. You're digging a deeper hole for yourself. So what would it take to reduce the debt to GDP ratio? Well, the easiest way is growth, but we're not going to get growth. And I'll talk about a little bit more about that in a minute. The way the American way is inflation. You basically, it's like holding an ice cube in your hand and watching it melt. You inflate the debt away. So the nominal value of the debt can be unchanged, but by diminishing the value of the dollar, and that's what inflation is, that debt to GDP ratio falls into line. So it would take a 75% devaluation of the dollar to get the debt to GDP ratio from 130% to 30%. And people will go, that will never happen. You'll never have a 75% devaluation. Well, we've had this several times. What do you think happened when in the 1970s, when gold went from $35 an ounce to $800 an ounce? That was an 80% devaluation of the dollar measured by weight of gold. So something similar would put gold at $8,000 an ounce. Gold at $8,000 an ounce would be a 75% devaluation of the dollar measured by weight of gold. So I just gave you three methods. One was a technical method. One was involved money supply. And the third one was involved managing the debt to GDP ratio. If you take the simple average of all three, so one had a $14,500 per ounce price target. One had a $12,000 per ounce price target. One had an $8,000 per ounce price target. The average of the three is $11,500 an ounce. So I'm not forecasting that any one of those three things will happen. All three of them could happen. The last one, the inflation scenario, is extremely likely to happen. Talk about that in a minute. But all of them get you to about the same place. And again, $10,000, $11,000, $15,000 for a range. I would really say there's a range from $10,000 to $15,000 per ounce, but just take the low end of the range, $10,000 an ounce. That's where we're going. A couple other factors driving it in that direction. Central banks since 2010 have become net buyers of gold. For 40 years before that, from 1970 to 2010, they were net sellers. All of a sudden, it stopped on a dime. 2010, the IMF sold 400 tons. That was the last major sale by any central bank. Canada sold their gold a little bit later, but I think they had, 100 ounces or something. They didn't have much gold. But basically, central banks today are net buyers. Mining output is flat the last 5 years. Mining output globally is around 3,100, 3,200 tons. I'm not forecasting peak gold. I'm not a geologist. I don't have to forecast peak gold, but I can look at the data and see that that's flatlining. So when you have a situation where demand is going up, which it is from the central banks, and supply is flat, which it is from the miners, that by itself is a recipe for higher prices because you have to go to the secondary market and bid it up to get any. So there's a host of technical, geopolitical, monetary, and supply demand factors that all point to a significantly higher price for gold. Now, let me just finish up by talking about inflation, because if you get inflation, nothing else matters. Like everything I just said is, good substantive analysis and the facts back it up. But inflation will take care of it by itself. That's what inflation is. The value of the dollar goes down, measured in, well, it could be corn, wheat, steel, copper, a lot of things, but gold is number one because gold is an alternative form of money. And here, the driver will be demographics. China has had an inflection point for the last 30 years. The increase in their workforce, the increase in a low wage workforce has been an extremely deflationary trend. But today they're at the point where the workforce is aging rapidly. They're now paying the price for the one child policy. There's something called a dependency ratio. The dependency ratio is what is the number of working age people, what is the working age population relative to the size of the population that is retired, elderly, just not working, simple as that. They're consuming, they're just saving, but they're not working and they're not producing. So in a healthy society, you have a very low dependency ratio. You have relatively few older people, a lot more working age people. And that's what we've had for a long time. That's what we had with the baby boom in the United States. And that's what China had. But right now, literally as we speak, just in the last couple of years and getting worse, with Japan as the canary in the coal mine, but China there on a larger scale, the United States and Europe not far behind. We have this inflection point where in China, you're very quickly going to have one grandchild per 4 grandparents. So there are going to be 4 grandparents in their 80s, let's say, and one grandchild who's 30, 35 working, supporting, in effect, the 4 grandparents. It doesn't have to be literally, your exact biological grandparents. It's the ratio that counts. But it's supposed to be the other way around. 4 grandparents are supposed to have 16, 20 grandchildren. It's the opposite. You're going to have one grandchild per 4 grandparents, because that's what the one China policy has done to China. But you're getting to the same place. Sorry, the one child policy has done to China, but you're getting to the same place for other sociological reasons. In Japan, I had a conversation with Saki Kibara-san. He was the assistant minister of finance in Japan in the 1980s, very famous. He was known as Mr. Yen. And I said, Saki Kibara-san, your population is declining. You've been in a 30-year depression, which they have since New Year's Eve 1989. So how are you going to get out of that? And he said to me, well, here's what you're missing. He said, but our population is declining. So our per capita performance is much better than our gross performance. And I understood what he was saying. I said, well, you're exactly right. We look at the GDP of Japan, but if you do it per capita, they're actually outperforming the gross number because the population is declining. I said, so where you're going to end up is, in 50 years, there's going to be one Japanese left, and she'll own the entire country and be the richest woman in the world. But that was sort of the reductio ad absurdum of what he was saying. But he was right about the demographics of that. But what it means is very low productivity. You don't get growth. I talked earlier about growing your way out of a debt crisis, but we're not going to get the growth. When people are 80, 90 years old, a couple of things happen with that kind of longevity. Imagine 100 years old. The first thing is, to a great extent, Alzheimer's and dementia and Parkinson's disease are highly correlated with age. It doesn't mean every old person gets Alzheimer's. It does mean that the number of Alzheimer cases skyrockets as the average age goes up. And the same thing with dementia. It's just a fact. And for some reason, it seems to be slightly worse in Asia. I don't know all the genetic or biological factors that might go into that, but it's pretty bad all around. Well, when you have dementia, you need a lot of care. You need a caregiver. You need to be bathed. You need to be fed. You're not out working. You're not saving. You're dissaving, meaning you're spending your money, et cetera. The thing about bathing is robots can't bathe people. Bathing is a very labor-intensive activity. It's an important activity. I compliment and praise the caregivers. My point is that we're going to need a nation of caregivers to take care of the nation of non-productive elderly. And that is not a job that can be automated. It is not a job that lends itself to the kind of productivity gains you can get in other areas of the economy. So what you end up with is fewer producers, more people in the working age population who are giving the kind of caregiving I described, which is important, but it's resistant to productivity gains. You don't, as I say, you can't spoon feed somebody or bathe them with a robot. This will lead to, and then there's also slowing globalization. Name your factor, nationalism, America first, Europe first, whatever it is. But globalization has now hit the brakes. And that was another driver of efficiency and productivity, et cetera. So put all this together, you're looking at a low growth, low productivity world with massive shortages of workers. The labor force is going to be way too small. What does that mean? It means higher wages. So I'd say Harry, I've studied his books and works and speeches. Harry's exactly right about the importance of demographics. He's exactly right about slow growth. But where he gets it backwards is suggesting that that's a deflationary trend. It's not. It's a highly inflationary trend, and we saw this in the late 14th, early 15th century, after the Black Death. The Black Death killed 75 million people. Estimates vary between half and between 1/3 and 1/2 of all the adults in Europe died in the Black Death. Well, guess what happened in the late 14th century? Wages went up. They went up a lot. Income inequality went down. It was as if you had, the AFL-CIO in 14th century France. But the point is, it was a period where there was inflation and wages went up a lot. The reason was exactly what I'm talking about, which is a massive labor shortage. So all of this, the demographics that Harry puts a lot of weight on, and I agree with Harry, the demographics are like a tsunami relative to, everything else is like kind of playing with sand and puddles. Here comes the tsunami. Well, the demographic wave is coming. It's going to make people a lot older, a lot more ill, a lot of mental illness, lower productivity, more call for caregivers, which is a low productivity occupation. And it's going to drive wages much higher. And that is inflationary. And that's one more factor why the price of gold is going to go up, because it just does in inflation. And just one last footnote. Harry was talking a little bit earlier about, certain emerging markets outperforming others, et cetera. That's generally not true in a world of floating exchange rates. In a world, in the pre-1971 world, or pre-73 world of fixed exchange rates, that was true, because if your currency was overvalued, you had to basically have a depression and lower your unit labor costs to justify that valuation. But in a world of floating exchange rates, the adjustment doesn't take place in labor costs, it takes place in the exchange rate, in the terms of trade. So whatever trends are going on, and I just described them, they go all over the world. They don't stay in a bucket. So the point is, globalization has hit the brakes. We're at a demographic inflection point. The workforce is getting older, less productive. More people are going to be engaged in kind of not non-productive, but activities that do not lend themselves to productivity enhancements. That's going to drive wages much higher. That's inflationary, and that's going to take the price of gold exactly where I say.
Right. Thank you, Jim. Now, Harry, if you can unmute yourself, mate, and we're ready, and get your slides operating, that'd be wonderful.
Okay, great. Good day, everybody. I'm going to run through some important slides very quickly. You are going to get these slides, as Greg said, so you can go after them over them more in depth later, because there's a lot of important information here. My view is that every major bubble, except for rare third world and Weimar Republic, when you lose a war and go bankrupt and then borrow overseas, it's usually overseas debt that causes a hyperinflation. That most bubbles burst with deflation, because debt and financial assets that build up in a bubble disappear. And then that causes not only assets to deflate and debt, but also spending and businesses and unemployment and everything. So I see deflation, even though there will be inflation down the road, I see deflation as the most likely outcome here when we crash. Now, two important cycles. 90 years since stocks started in the Industrial Revolution, and Harry met Sally with democracy and free market capitalism, greatest explosion ever. The stock markets have been going up exponentially, and this is a log chart and it's still exponential, but the one trend that is crystal clear that stands out, 90-year super bubble and then great reset cycles. 1837 to 42 after the great Midwest expansion. And I'm not going to get into what the governments did to stimulate there. And then the 29 to 32 bubble crash, which everybody knows. And now the greatest bubble, the most global ever. So we're right in that. In fact, we're about a year late on this because they've been stimulating so hard to avoid it. Another important cycle on demographics. Stocks tend to peak a little less on cycle than they bottom. Generation bottoms had come in 42, Henry Ford generation, 82 Bob Hope generation, and now baby boom, late 2022. I have been predicting since the 80s when I was super bullish that we would see the lowest stock prices of our lifetime at the end of 2022. And I still say that it just might be a year later because of all the money printing to stall on that. Most important concept here, my important breakthrough indicator from demographics and inflation is the 4-season cycle. Generations drive booms and then bust, and then inflation is driven especially by high workforce growth, which the baby boomers exaggerated, and of course immigration cycles do as well. But here's the key point. We hit the peak of the fall bubble boom season in 2007, went into a deep downturn that started to look like a depression, and they didn't know what to do. You couldn't get people to borrow more. They borrowed off the charts, businesses and consumers and governments in the boom. So they found out, oh, you just inflate, quantitative easing. If you keep printing money, at least financial assets go up, okay? The reason this hasn't caused inflation is going into financial assets, not consumer spending, and we're in the winter season, 2008 to 23, which I've been forecasting for decades, when deflation, falling demographic trends, which is deflationary when it's spending trends falling, and high weight of debt and financial assets that weighs on the economy and eventually has to deleverage and wants to. This is why we've been printing 25 trillion, now well over 30 just after COVID, adding that. We can't create inflation because we're in a deflationary era. If we'd done this sort of printing money in the 1970s, we would have had hyperinflation. Real quickly, great chart from Ray Dalio. Here's what happened. Just look at the top real quick, because I could say a lot about this. Last time we had a big bubble, the debt bubbled up and then it deflated, not government debt. Governments always go more into debt when there's a crisis because they have to fund everything and bail everybody out. 62% of private debt was deflated after that 29-30 bubble peak. Now we see the 2007 peak later, and what happens? We barely deflate at all. In fact, new debt's being created, particularly in emerging countries. So we haven't deflated the debt, which takes the excesses out and allows unproductive investments to be cast away so we can grow again, especially when demographics turn around. Now, what I've been saying for years, yeah, they started printing money and they said, oh, this will be a short-term crisis. No, it's a long-term demographic and debt crisis, and nobody's dealing with it. So they're printing money to cover it over. And I said, it's going to take exponentially more. They just printed in the last year since the repo crisis, a little more than they did in the entire QE cycle before it, over 80 months in just 8 months. So it's taking exponentially more. And guess what? No inflation. Here's the inflation chart. Look at this. It just goes up 1.3%. Printing money at this rate, anybody that says, and Milton Friedman was dead wrong about this. He said inflation is entirely a monetary phenomenon. Well, not anymore. We've been printing unprecedented by any measure, and all we get is 1.3% inflation, and the Federal Reserve is praying for 2%, and they can't get there. Okay, what happens? Is there a correlation between money printing, the blue line, the growth of the balance sheet, and inflation? No, inflation was going up even faster before the money printing. Then it went up at about the same rate, and money printing got higher and higher, didn't budge at all. And then when they tapered in 2017-18, inflation kept going up, and now they've just shoved it up the roof, and inflation is still doing the same thing. It's going up in line with the same indicator I've already used, workforce growth, which is getting slower, but it's still positive for now. Gold tends to go up when they print money because the assumption, which rightfully normally would be, you print a lot of money and it's going to, and especially if it goes into consumer and business spending, it's going to cause inflation. But remember, it's not going into consumer spending. Everybody's spent out, or only the wealthy are spending more. And they happen to be, the top 20% happen to be 50% of spending. That's the only reason we're growing 4% growth in the up end, and on the bottom 80%, zero growth. But it's financial assets. But gold went up, especially with the money printing after late 2008. And then when Japan tripled down on money and the inflation kept falling, gold finally fell into late 2015. And it's rising again because money printing is stepping up. But again, I keep saying, where's the inflation? I've been saying literally out in public, it'd be impossible to create high inflation and really impossible to create hyperinflation in this global and US deflationary environment. So again, what's really happened, what really correlates with money printing is financial assets go up. Stocks, bonds, real estate, those sort of things, and especially stocks, because stocks are the highest return and benefit the most. Here's the US. Stocks have gotten 6 times GDP when normally is about 3-ish, okay? So just to come down and reset, stocks have to fall 50% in value. That's $61 trillion of financial assets that will disappear. So my view is, again, why did you get deflation in the 30s and not in the 70s? Because we had a great reset out of a bubble. Financial assets disappeared and did not come back for a long time. Debts, 62% we saw, were restructured down, money disappearing again. And then, of course, unemployment and business failures and bank failures and less spending as well. But the biggest thing was the disappearance of financial money, not bank accounts, but financial assets and debt. Here's the global picture. 2017, I had to really dig to find these damn figures, okay? And I've updated, here's the original analysis I do. Conservative, what it would take to deflate bonds and stocks and real estate back down to reality. And now I've just upped it recently because I don't have these figures updated, but I've updated for what I know is about the 525 trillion in financial assets. By the way, most important number in the world right now. 525 trillion of assets, 6.5 times global GDP, way off the charts. It should be like 2. And debt, 281 trillion, 24 trillion just added with COVID and more coming, 3.3 times global GDP. And it's going to deflate at a minimum. I'm being conservative here, okay? Original calculation, 205, this calculation updated for a little high. $225 trillion, 3 times the global GDP roughly of about 80 trillion, disappears. That is deflation, and I will leave the country and move to Mars if I'm wrong about this. That much assets deflate and you don't get deflation, then I'm the dumbest person on the earth, okay? I'll stand by that. Gold. Everything bubbled. We've been in the biggest bubble in history in money printing. Gold bubbled up. This chart shows not quite as steep, but over a similar time period, within 1 year, gold went up, 7.6 times? I can't see this because it's covered. And the NASDAQ went up 11. Gold bubbled too. I've always been debating people in the gold, and they say, the gold buds always said, well, look, the bubbles and money printing. I said, well, gold's in a bubble, damn it. And gold's going to have to reset to reality, and then it'll grow again. And by the way, when does gold grow? Historically, 30-year commodity cycle is one of the best cycles out there, most consistent. We peaked in 2008. Gold came later because of the money printing and silver, but the next one is 2040, and this one shouldn't bottom until at least 2023, something else I've been forecasting a long time. Now, here is the Great Recession. One of the things I see, remember I talk about that winter season, okay? 2008 to 23, the normal way that happens without endless money printing and quantitative easing, which did not really exist substantially in history. You have the big crash first, 29 to 32. Oh, most of the assets go. The same thing with Japan, 90 to 92. Stocks routed, real estate routed, take down the financial assets and the debt as much as possible. Japan didn't do the debt, and we did in the 30s, okay? That's the normal way. Big crash, 30, 32. You have a stimulus program that gets you back up into 37, and then you have a final deep recession or lesser depression into the end of the winter season. This time we're going to get the opposite because of this 90-year cycle, which hits later than our 80-year demographic cycle in winter, and this bubble being extended so long. We're going to get the big crash, by my view, from 2021 into 2022 or 23, and stocks are going to go down 80, 90%. But again, just to get a preview, what happened in the mini depression, in 2008. Here is the red line is TLT, Treasury bonds, and the blue line is gold. Gold did better first, held up in the early stages of down, but when things really got ugly with Lehman Brothers, oh, dollar goes up 27%, bonds go up 20, 30, 40%, depending on the duration, and gold goes running to mommy, okay? Gold was anticipating if gold likes to see money printing because that's going to cause inflation down the road. Did not happen. We started to see a depression-like scenario, and that's when they really turned on the spigot. Chart now, and here's the good story for gold. Gold goes straight up, much faster than bonds. We're coming out of this with massive money printing because it is favored by that. And at least we get a tiny bit of inflation. And bonds take a while to go down, but eventually they go up when monetary easing pushes down bond yields. But the point is, at the worst of the crisis and into the most important part, it was the Treasury bonds that were the safe haven, not gold. Gold looked like it would be until it saw deflation. Here's another chart from somebody saying, you know, gold back historically, not always, but often runs in 9-year cycles. And they're just saying, you know, I was projecting myself that with a trend line through the 230-year cycle tops, 1980, that was the biggest, as Jim said, that was the biggest granddaddy because that was the strongest inflation, and gold correlates more with inflation than anything. And Bitcoin doesn't, by the way. You want an inflation hedge, it ain't Bitcoin, it's gold, okay? I'll agree on that. The trend line up through here would be about 2,200. I could have seen gold in the early stages of a stock crash, like in 2008, continuing to edge up until they saw that deflation. But you know what? I'm not seeing that now. It's already underperforming and it's about to break out of a potential head and shoulders pattern on the downside. So we'll see. I think gold may have a little bounce here. And if it goes to 2,200, I'd be telling people that's where to cash out. And that's still a possibility. I do not see gold going to 10, 12, 15,000 because deflation does not favor gold. Gold is the best single inflation hedge on earth. Real estate is too, but it's more complicated. Now, real quickly, how do I see this playing out? Here's a typical topping process, megaphone patterns. I love these patterns. They only come at tops. People don't see them often. We've been going up, higher highs, lower lows. I keep reminding all these bulls, every time we make a new high, guess what? We make a new low. You know what the next new low is? 2,100 on the S&P. And that's just the first pop to this downturn that's going to get very, very deep and deflationary. This is an important point here. If we see this, and Jeremy Grantham is saying something very similar, somewhere between now and May, I agree with him, we're going to see a top. And the next crash is going to be the steepest we've seen yet. And that's when I think people lose faith in these dumbass, academic, never had sex, never run a business, central bankers, okay? They're going to lose credibility because they're going to want to print 20 trillion next time. I think they're going to start to lose credibility and people are going to finally see you don't get something for nothing by just printing money. The economy keeps getting worse and worse, not better and better, despite brief new highs. And guess, what's the safe haven? What's the last thing to know? We've had the greatest bull market in Treasury bonds ever with falling rates, following the greatest bear market from the late 30s, early 40s. I've been projecting back decades that by the end of 2022, we would see the lowest Treasury bond, risk-free bond yields of our lifetimes. And then they would turn up into the next spring boom and mild inflation cycle. Now, if you believe me, you should be in Treasury bonds. And what's the better bonds? The 30-year. Look at this 10-year bond. If I make assumptions a little deeper, and this is a conservative too, than we just saw in the flash crash last year, February, March, that the 10-year goes to 0 and the 30-year goes to 0.4. They went to 0.7 and 0.4 last time. So this is not, it'll probably be worse than that, maybe negative. 10-year would make 9.5% appreciation, 30-year 38% from locking in these measly 2.2% yields when they go to 0 for 30 years. That's how you make a lot of money. 0 coupon, a little more leverage, 40, almost 50%, and the TLT average 20-year, 22%. So I say buy 30-year Treasury bonds. or zero coupon. That is the best safe haven. If we do get inflation down the road, you can play gold and other things there. I say, and I'll stand by this, deflation comes first when $525 trillion of financial assets and $281 trillion worth of debt eventually has to deleverage. And for Bitcoin, we had the debate with Michael Turpin a few weeks ago, and I'll just show this briefly. Here's my view of Bitcoin. I think it is, along with blockchain, more importantly, the next thing how financial assets get interneted, okay? The digitization of all financial assets and money, okay? But it's in the early stages. I compare it to the dot-coms and Amazon. The internet index went up great into 2000 and a few and then crashed. They were the end of the first tech bubble. Amazon did better than ever because it was one of the leading stocks and then crashed. 95% crash. That's my projection. Let's say 58,000 was just the top, and I put out an update to my newsletter subscribers today. That could have been a top, okay? To go down 95% would take it where? 3,000, where it bottomed after the 2017 crash. That'd be the fourth way. I got a million. 3,000 to 4,000 is my target for Bitcoin. A couple years from now, it is not an inflation hedge like gold, and it is definitely not. It's the worst possible safe haven on this earth because it's the biggest bubble of all bubbles, like the dot-coms were in the last tech bubble. So that's my view. We are in a bubble that is beyond anything we've seen before, more global, more pervasive, all asset classes, almost everywhere. And now the emerging markets are joining in late stage. And of course, crypto and Bitcoin and crazy stuff like GameStop, which showing there's so much money floating around, you're just going to keep bubbling stuff until it blows. Somebody asked me yesterday in an interview, how does this thing blow? I say, you know what? I don't know. Do you know in an avalanche when that one snowflake adds in or that one grain of sand on a mound and then it all of a sudden collapses? That's what's coming, or I'm going to quit my profession in the next 2 to 3 years. It may be less deflationary, I say or not, but it's going to be deflationary. This bubble is going to burst, I think, very soon now. It's been stretched so far. They're printing so much now, it's making no difference. What are they going to do next? 10 trillion? And then when we crash, are they going to recommend 20 trillion? And then, but if you go back to that one chart, just to end here, where the bonds did better in the crisis, but then coming out of it with the money printing, gold did better. That's where I could see gold in a second stage of this towards the end doing well. And guess why I like gold long term? Not because of inflation. As Jim said, demographics say a low inflation, low growth world, even in emerging countries increasingly. Asia is going to be the dominant part of the world on a cycle I have into the next several decades. And Asians love gold. Chinese by the most, Indians a close second, but Indians as a percentage of their incomes by way more than Chinese. And India is going to be the biggest growth story of the next 30, 40, 50 years. I would buy gold hand over fist when it hits my $1,000 give or take target. And by the way, that is going to be way less than commodities and silver, way less than stocks going down, more like real estate. Gold is not the worst place to be in the crash. And in fact, you're really sitting there listening to me and Jim say, these both guys sound good. Here's what you can do. 40% short stocks, unleveraged, SQQQ, let's call it. 30%, 30-year treasury bonds, and 30% gold, so you're covering all bases. I would just take the stocks and the treasury bonds, you know me. But if you want to do that, that's another way to play this.
Harry, thank you. I've got to tell everybody, I like it when Harry gets worked up. And remember, Harry's going to be coming to Australia as soon as we can get him on a plane and get him out here. And you must come and hear Harry Dent live. We take him Sydney, Brisbane, Melbourne, Perth. By then, he's almost over the jet lag, and then we put him on a plane and send him back. But you've got to come and hear this guy live. He is sensational. But at any rate, thank you for that. I like your challenge to Jim. So let's get right into it, gentlemen. And I've got some questions here for you both. And the first question is, you're both saying we're in the new Great Depression or heading into the new Great Depression. So the question is, how do you reconcile your negative views with such a positive market behavior at the moment? And I might ask Jim, would you like to answer that first for me? And you'll need to unmute yourself, Jim.
Yeah, I think, can you hear me?
Yeah, we can hear you now, mate. Can you answer that first? I'll come to Harry after that.
Sure. a lot of people don't understand what a depression is. You know, a recession with the R, 2 or more consecutive quarters of declining GDP. So economists like it because it's quantitative. You can plug it into a closed form equation. They like that. Depression, the D word. Economists have banished the D word. They don't like to talk about it because they think they're too smart to ever have one. We're in one now. Japan's been in one since 1989. You can have growth in a depression. Depressions do not mean continuous declining growth. What they mean is occasional technical recessions and growth, but growth below trend. It's depressed growth. So if your trend is 3.2% or your potential is 3.5%, and you're growing at 2.2%, which we were from 2009 to 2019, or I expect even less, maybe 1.9% in the coming years, that's depressed growth relative to trend. That's a depression. If 1%, the difference between say 3.2 and 2.2, if that doesn't sound like a lot, it is. You take 1%, put it on a $24 trillion economy and compound it over 10 years, you're looking at $3 to $4 trillion worth of, $3 to $4 trillion of lost wealth, lost output, money we could have had if we could have performed at a trend. So you can have the depression, but you can still have inflation. There's a name for it. It's called stagflation. We had it in the late 1970s. In other words, I am projecting slow growth. I am projecting a depression. The effects of this pandemic will be intergenerational. They'll be with us for 30 years. But that doesn't mean that you can't have inflation. And by the way, I should just add, because I was looking at the questions myself. I can't answer all of them. There are too many, but I think it's great that there's been so much participation. But one of the questions that came out was, hey, Jim, in your new book, you talk about deflation, and yet you just spent 20 minutes explaining why we're going to have inflation. And they're both true. Very short term, meaning the 2021, the tendency is still towards deflation and disinflation. What's amazing about gold is that with deflationary headwinds, which we have had, gold has still gone up, almost doubled in the last 6 years, and it's held up very well. It gets knocked down every now and then, but if you had the kind of impact Harry's talking about, why isn't gold at $1,000 already, or even lower? So I'm impressed with the performance of gold in a deflationary environment, which we have had. But we're right at that inflection point. We're right at the point where it tips into inflation and accelerating inflation beginning in 2022 and thereafter. So the way to reconcile that, very short term, meaning a year or less, more disinflation, borderline deflation, but that's going to turn very quickly. So that's how I would reconcile that. And by the way, just to be clear, I agree with Harry that we have come through enormous deflationary trends. I mean, that's absolutely correct for the reasons I mentioned, which were the cheap Chinese labor, hundreds of millions of people coming off the farm, going into Lego style assembly, and other factors, and then all the money printing. The reason the money printing didn't produce inflation was because it was just holding its own against the deflationary trends, which were demographic and globalization and automation and a number of other factors. But the point is, and what I think is being missed in the discussion, is we're right at the inflection point. So if you ask me about Harry's thesis about deflation, I say, yeah, that's been the story of the last 20 years. Absolutely right. But we're right at the point where that's going to flip. You can't just extrapolate deflation. You have to watch the turning points, the tipping points, and we're right at one right now.
Harry, your thoughts on that question?
Okay, I am crystal clear about what depressions mean typically. Depressions, almost the thing they always involve, unlike the 1970s, and unlike what we've even seen in Japan with kind of zero inflation or deflation, it's the deleveraging of debt and financial asset bubbles. That's when you see a depression rather than a deep depression. Demographics predict deflation or inflation because slowing workforce growth is deflationary, and rising rapidly, like in the 70s, is inflationary. So in the 70s was due to be an inflationary thing, and people now still think the governments printed money in the 70s. They didn't. They ran deficits in a recessionary, inflationary economy, duh, but they were not printing money off the charts like they are now. They did print money in 1932 at the end of the first crash because it was so bad, but they printed it like 6% of GDP rather than now. Real quickly, when you print all this money and do all these assets, why do I not listen to the markets? The markets are on crack, okay? Would you listen to a crack addict and ask them, of crack addicts on a roof, what are they going to do? They're going to try to fly off of it. The markets have been fed free money. All this money comes in, adds to the financial asset pool. It's not been given to businesses and consumers until just recently with fiscal stimulus. It pumps up financial assets. They're on crack. They're going up. They don't need a good reason. Oh, but they have earnings and the price earnings is not that high. There wouldn't be any earnings because there wouldn't be any economy. We'd be like Japan or worse if it weren't for this constant money printing. Everything is fake and artificial, and the markets are so high they don't know it. And they don't want to listen to me or Jim because everybody out there, from Warren Buffett included, everyday people, financial analysts, Wall Street, everybody's high. Nobody high wants to be told they're high and they're heading towards detox. Debt deleveraging, financial asset bubbles is detox. It sucks. That's why nobody would choose it. Central banks will not choose it. They're going to blow this thing until they have the avalanche, and then deflation will take over. The economy will heal itself so fast. Income inequality will be solved so fast. Debts will be leveraged like they did in the early 30s. 62% of private debt disappeared. That's good. That's a detox. That makes you healthier, even though it almost kills you. So that's the way I see depressions. That's what's unique. And depressions have deflation. Japan's only thing, they had the financial assets deflate at first. They never let the debt deflate. That's why they're in between inflation and deflation, and they're going to end up in deflation. And guess where Japan's demographics go? Down again as strong as they did in the 90s. So Japan is going to deflate this time because they're going to go down so hard they'll have no choice. Our markets are going to cause this crisis, and then debt gets restructured because the markets collapse, and the economy cannot grow without these markets feeding the rich, who are the only people still spending money out there. So if you're selling yachts, sell them now because they're not going to be selling very soon. The rich are going to lose the most money when this bubble bursts, not the poor.
Harry, I'm going to continue on that vein of printing money because, you know, we hear that as they print the money, 70 or 80% of it leads to the share market and places like that. The Federal Reserves have pumped $4 trillion into the economy. In fact, we're told that they will potentially continue to print money for many, many years to come. Why do you think this monetary stimulus just won't work? Harry, you first.
Okay. Do you remember that number I threw out? The most important number in the world. What was it? Just for that to deflate normally back to somewhat reality. 2 to 250 trillion disappear. 2 to 250 trillion. So do you think Jerome Powell or Janet Yellen, thought I saw a putty cap, okay? You think they're fast enough on the draw to print that much money ahead of time fast enough? You think they're gunslingers? You think they got the to do that? And do you think people will let them? If after we just printed more money in 1 year and more fiscal stimulus than the whole past cycle, and we still fall into recession again, and that's the key. We have to fall, the economy has to weaken, or the markets have to weaken to trigger this. But if that happens again, do you think people are going to say, well, why don't we do the same thing we did before? Duh. I think the people say, well, maybe you do. As soon as this thing cracks, all I think it takes is that 47%, that's a megaphone pattern. You want to argue with that? Good luck. It's one of the most reliable patterns. A 47% crash in the S&P, which means 50-some% in the NASDAQ, I think will tell people will wake up and say, oh, this really doesn't work. And then when they come up and say, well, now we're going to print 10 or 20, people are going to go say, well, I'm not going to say the words they would say, okay? You know what it would be.
But Harry, what about if they keep printing for the next 10 years?
Yeah, you can, but they just printed 10 times the rate they did before, and it didn't do much for the economy except for restore a quick downturn, and it didn't create any inflation, which is their target. But somebody has to let them, they can't just print money. I mean, what if people start rioting in the streets and say, I'm sorry, you guys, we let you do this for 12 years and it failed. I think people are smart enough, even though they're on crack, everybody's on crack here, okay? Even everyday people are getting a 3% mortgage when it ought to be 6 or 7, getting a 2% car loan when it ought to be 7 or 8 with higher risk. Everybody's high. Everybody's getting a benefit. The economy has lower unemployment than would have if we hadn't printed 30 some trillion dollars and now tens of trillions of fiscal stimulus. So I think people will get it, but that is where I could be wrong. People are stupider than I'm assuming they are. I think they'll wake up. What I found about people, when the barn's burning, people get real smart and they become heroes overnight. They run in and save the baby and the horse and run out. They quit being an everyday dumbass Homer Simpson and they do the right thing. I think a crisis is going to wake people up. And I think it's going to come in the next few months with that first 47% crash. And if that doesn't happen, then I have to recalculate.
Okay, but if in 5 years' time they're still printing, could this lead to a melting American dollar?
Well, has the dollar melted with all this? Okay, let me tell you about money printing. Percent of GDP, something real. How much is Japan printed? 128 last I looked, probably more by now. Europe, 50. US 40, 42. We're the best house in a bad neighborhood. And oh, China doesn't print as much money because they are busy printing condos. They're building shit for nobody. That's the worst thing you can do. Overcapacity. You know that China went from 20 to 60% urban in 3 decades, the fastest of any major country. But today, if they didn't build another thing, they could go to 80% because they got 22% of nowhere. China is dead. They did the worst money printing. We're the best house in a bad neighborhood. That's why I say when the you-know-what hits the fan, like it did in 2008 with Lehman Brothers, dollar up, other currencies down. We're going to go up, and I will bet half of my career on that. Not forever, just in the crisis. And the treasury bonds with them, up, not gold.
Harry,
Gold went running last time, Jim. It went running when it saw a real crisis, Lehman Brothers, financial institution melting down like the 30s.
Harry, your camera's just slipped a bit there, mate. I'm going to go to Jim. And Jim, now Harry got pretty hostile about the stimulus and this printing money. What are your thoughts?
Yeah, let me see if I can correct 5 hours in 5 minutes here. We'll do like a lightning round. First thing, printing money has nothing to do with inflation. It's not what causes inflation. The quantity theory of money is M times V equals Q times P. Q times P is nominal GDP if you multiply them out. M is money supply and V is velocity. And Milton Friedman used to say that a mature economy can only grow in real terms about 3.5%. And he was right about that. And he said, we want inflation to be 1, meaning we don't want inflation or deflation. If we want nominal GDP to equal real GDP, that means the P has to be 1. And velocity is constant. So all you have to do is dial up the money supply or dial it down to get 3.5% real growth with no inflation. You don't even need a central bank or a board of governors. You just need a computer to run it the way I described it, like turning up a thermostat in your house. Milton Friedman was right about everything except one thing. He was wrong about velocity. Velocity is not constant. Velocity is highly volatile. Velocity has been dropping like a stone, depending on whether you use base money. It's been dropping for 20 years. If you use M2, it's been dropping for about 10 years. But the point is, if you increase the money supply and velocity goes down, your nominal GDP is unchanged. So the way I describe it is, 7 trillion, the Fed went from about 3.5 trillion to 7.5 trillion in less than 1 year. That's true. They did print $4 trillion of new money, but $7 trillion times 0 is 0. Meaning if you don't have velocity, you don't have an economy. So forget the money supply. They could go to 10 trillion, as Harry said, they could go to 15 trillion. It won't matter. It will not cause inflation unless velocity goes up. So let's talk about velocity. Velocity is a psychological variable. It's not something that the central bank can control. Right now, velocity is declining because when you have interest rates at 0, which the Fed does, what signals does that send to people? It says, the Fed's worried about deflation, and they should be worried about deflation. They have been. So why should I go out and spend money if you're going to have deflation? Why should I borrow money? I'll save more. My money will be worth more. So you got to change the V. That's a psychological variable. What's going to change it? Well, the government could target the price of gold at $5,000 an ounce. I doubt they will. I'm not forecasting that, but that's one way to do it. There could be some other shock, but the shock that's coming is the one I described, which is wages are going to go up. And I don't understand how Harry and I can agree on demographics, which we do, and you can't disagree because it's in the data. You can't make up data. Harry and I both see the same demographic wave, but I can't understand why if the labor force is declining, why that's deflationary. That's highly inflationary. We've had deflation for the last 20 years because the labor force was growing and it kept wages low. The minute the labor force stops growing, which it is starting now, wages are going to go up, which is inflationary. So I don't see how how can you have deflationary in a world where the labor force is growing, but it's also deflationary in a world where the labor force is shrinking. It doesn't work that way. Labor force is going to shrink, but that's going to drive wages higher, which is inflationary. The other thing that Harry said that I just couldn't understand, he said, I forget the exact number, we have 500 trillion or whatever of debt. We have to deflate the debt, deflate the debt, deflate the debt. Well, there are only two. First of all, debt, you got to look at the right side of the balance sheet. Debt's on the liability side. It's not an asset if you're the issuer. So there are only two ways to deflate the debt. One is default. You can default, not pay it, and then the debt goes away. Of course, that will destroy the economy and cause something far worse than the Great Depression. But the other way to do it, the American way, is to inflate. In other words, the way you deflate the debt is by inflating the currency. Because when you inflate the currency is worth less. Well, guess what? That means the debt is worth less, and you can actually manage the debt. And that is what we did from the end of World War II to 1980. Now, 1980, it turned around, but basically we had slow inflation. Then we had rapid inflation. We didn't quite get to hyperinflation, but we basically melted the debt, made it go away. So in other words, I agree with Harry that the debt's out of control and has to go away. But there are two ways to do it: default, which will be, again, we'll be back in the Stone Age, or inflate, which is what's going to happen. And so it'll just go away. But in other words, deflation of debt equals inflation of currency, and that's what I'm talking about. And that drives the price of gold higher. As far as the dollar going down, the dollar going up, there are only like 5 people in the world who actually understand how to measure the dollar, because everyone looks at DXY or the Bloomberg index, or the Fed has a broad trade weighted currency index. Now, I look at all of them. I mean, they're on my screens, my trading screens every day. But all they do, the dollar is 60% of global reserves, or dollar denominated assets, I should say. But about 25% is the euro. So 85% of global reserves are denominated in dollars and euros. So the euro-US dollar cross rate is about the only exchange rate that matters. You can trade sterling and Swiss francs and New Zealand dollars to your heart's content, but they're just tiny little markets. You can make it lose money, but the whole world basically revolves around the euro and the dollar, and the euro-US dollar cross rate is the only one that matters. But that's not a measure of the dollar. That's just a measure of a cross rate. If you want to measure the dollar, you have to look at gold, precisely because it is a form of money, but it's not a currency that comes from a central bank. And what's happened in the last 6 years? The price of gold has almost doubled, which means the dollar has gone down 50%. So the dollar crash has already happened. Nobody noticed because they don't look at the right yardstick. They're looking at the euro dollar cross rate. You have to look at the price of gold, and the price of gold has almost doubled. It actually did double as of last August. In the last 5 years, which means the dollar went down 50%. So the dollar crash already happened. It's just a lot of people weren't paying attention. And the last thing, Harry's kind of banging the table about gold going down in the immediate aftermath of Lehman Brothers. Yeah, it did. It also did last February when the stock market crash started. The stock market crashed 32.1% between late February and late March. That always happens. It has nothing to do with gold. It has to do with the fact that if you're a leveraged stock trader, and first of all, 95% of the stock trading is robots. So it's not you against somebody else who disagrees with you. It's you versus the robots. So the way to figure it out is figure out the programming, the algorithms in the robots, and front run the algorithms. But these, when stock markets crash and leveraged investors get margin calls, when you're in distress, you don't sell what you want, you sell what you can. And gold is highly liquid. You can always sell it. So what happens is, the hedge funds and others sell gold to get cash to meet the margin calls on the stocks that they're losing. And that's why gold goes down in the immediate aftermath of a crash. But it's a very short-lived period. Harry's cherry picking like a 30-day drawdown. And that is the data. Harry's right about that. But that's about a 30-day window. What happens is the weak hands puke the gold to get cash to meet the margin calls. But strong hands sit there and they wait until the last week hand pukes it, and then they buy it, and then it goes up from there. And so the gold went down, running from Ami or whatever Harry said, in the wake of stock market crash. It's true for about 30 days, but sophisticated gold investors know you just wait 30 days and then come in at the bottom and buy it up.
Hey, real quick, Greg. I mean, Jim, I hate to say, you're describing disinflation, falling inflation, not deflation. Deflation is negative inflation. falling prices. We only saw that for a flash in 2008 before they printed so much money. And you're saying, you're admitting money printing doesn't cause inflation. Well, tell that to the people buying gold, because the people buying gold were following the money printing, saying it's going to cause inflation. And gold went from 1934 to 1050 in several months, from late 2008 into 15 into 15. I'm sorry. Into 15, late 2015, because there was no inflation. So tell people that people are expecting that. I agree with you. It doesn't cause it unless the money goes into spending and business and consumer spending. It will not cause inflation. And
That's
only
my point. That's my point, Harry. For the last 10 years, the money printing has not gone into borrowing. It has not gone into consumption. I agree with you. I agree with you. I agree with you. But you're taking the last 10 years and projecting to the next 10 years. The next 10 years are going to be.
I'm just projecting the next 2
completely
years
different.
when all these
Completely
525
different.
billion of assets deflate and destroy money so fast you couldn't print it fast enough.
But Harry, you haven't explained. Harry, you keep yelling that's deflating. You don't explain how it deflates. You don't know how it deflates, Harry.
You listen to me, but you say the solution is to inflate your currency. They've been trying to do that for this whole time, for 12 years, and they can't do it. They can't inflate it. They printed $30 trillion. What's it going to take, 100? You're saying it doesn't cause it. You say inflate the currency. There is no choice to inflate the currency. Deflation is the only way to take out this unproductive assets. And by the way, Jim, you're wrong about workforce growth. That is my inflation indicator. I invented it in 1989. It's worked like a charm. We've seen lower inflation with slowing workforce growth. We haven't seen declining workforce growth. Now, if you look at workforce growth, who's got the lowest inflation of the major countries? Japan at 0. Who that? Oh, Europe, 1%. We're average 2%. That's because the differences in workforce growth, and Japan hasn't let their economy slow down enough. They keep stimulating it at 3 times the rate we do to keep deflation at bay. We have not seen deflation, Jim. When we do, it's exactly what you said. It's going to be the most painful thing we've experienced since the 30s. The stock markets don't know what it is. People don't know what it is, and they're going to get their ass kicked. And the only grace about this from history is it's going to happen so fast, and it's going to change things so fast. We get thrown into crisis and we end up hopefully doing the right thing instead of just printing more money as if it would work anyway.
Jim, here's the thing, Harry. Screaming is not a form of analysis. Let me explain this to you. You said we have to deflate the debt. You never said how you deflate the debt. There are only 2 ways.
It fails. It fails.
Okay.
62% failed in the 30s.
Okay, so you think, yeah, well, look, if Harry's right, and as I said, there are only 2 ways to get rid of this debt. We do have to get rid of it, but there are only 2 ways. You can default or you can inflate. So I think we agree on that. We're going to inflate, not because of central bank money printing, but because of the demographic wave. I just don't understand how Harry can agree that the workforce is declining, which it is, but that doesn't drive wages up. And that's just simple supply and demand. Fewer workers in a world of lower productivity because of aging. They're going to be in a very good position to demand higher wages. They're going to get the higher wages. They're smart enough to know that the wage increases have to be greater than inflation, or else it's not a real wage increase. And that's going to drive inflation even further. And that will melt the debt in effect, because the nominal value of the debt will still be there, but the dollar will be worth less. It'll be easier to pay. If Harry's right, and the way out is to default, what, on the United States Treasury? You want to default on the US Treasury, Harry? Is that the idea?
Don't deflate the government debt. It didn't deflate in the 30s. The private debt is 3 to 1 to government debt in the first place. And that's what deflates. The only thing that gets the government out is once you deflate and take all these burdens off consumers and businesses of unproductive debt that's weighing everything down, the economy grows faster again. It will never grow as fast as it did in the 50s and stuff, but because demographics is weak.
But just to be clear, when you say
that helps the debt ratios go down.
Yeah, but just to be clear, when you say deflate the debt, you mean default.
Default.
That's okay, exactly. Default. Okay, yeah. Well, that's not right. That's not going to happen.
Is there any other way to do it? How else?
Yeah, there is
much. That's Puerto Rico's approach down here, by the
way. Yeah, there is another way to do it, Harry. It's the way we've done throughout history, which is inflation.
How do you create inflation when 30 trillion money printing hasn't created any inflation?
because
Japan's printed more than anybody.
I
They
did,
have
well, I explained it 3 times, but I don't mind doing it a 4th time. When
I
the
didn't
labor,
get it, Jim. Zero inflation
well, why don't you
not
listen for a
inflation,
second,
not
Henry?
inflation. How do they
Okay, just,
inflate? They printed more than
well,
anybody.
well, I said the central banks can't do it, but I also said there are other factors, psychological factors, behavioral adaptive behavior factors that will cause the inflation. I've said it 3 times. I'll say it a 4th time. Take notes, which is that when the labor force declines, wages go up. That's inflationary.
Not when it's a depression, not when it's because of a down economy. Yes, long term that could happen, but not in a crisis.
It's starting now.
Gentlemen, I'll keep it moving because I've got many other questions for you. There's a vaccine been rolled out for COVID, which is now going around the world. Do you believe this vaccine will solve the pandemic problem? Will this then lead to a quick fix for the economy, or do you believe that we're in for a long hangover? I'll get to you first, Jim.
Yeah, first of all, it's not a vaccine. It's genetic modification. It's a gene therapy. It's kind of like chemotherapy for people who don't have cancer. So I wouldn't call it a vaccine, but it's out there, and we don't know the side effects. That's a long-term thing. We don't know if it's potent against new variants or strains of the virus. Hopefully, it is. If you get this gene therapy, this genetically modified, it's experimental, by the way. So it's experimental genetic therapeutic. If you get a jab, you get a needle of it. You're not, first of all, you're not immune to COVID. You can get COVID. It's just that it will suppress the symptoms. So your experience could be better, although for most people it's not that bad. You're still contagious. You can still transmit it to others. So it does have some beneficial effects. It could have a lot of side effects, may or may not be potent against the new strains, but it doesn't really matter. And the reason it doesn't matter is because the psychological effects are going to be with us for 30 years. Meaning, let's just say all the restaurants open up, okay? That'll be a slow process, but let's just say they do. The ones that survive, not counting the 50% that are out of business, where the job losses are permanent, the lease is defaulted, the equipment's up for sale at fire sale prices, and those people are never getting their jobs back. Leave them aside and look at the half, let's say, that actually do reopen. It doesn't mean people are going to run right out to restaurants. They're afraid. They've been kind of, bludgeoned by the government and the neo-fascists like Andrew Cuomo and Gavin Newsom, who basically have got everyone so afraid. And, not everyone's a scientist. Not everyone's can study the immunology. They just know they've been told to be in the house for the past year. It doesn't mean they're going to run right out the first chance they get.
Harry?
Yeah, I think you've already seen most of the recovery because you had a big hit to spending, businesses and consumers. Businesses were failing, and they just gave everybody money, consumers, business, everything, and they just spent it somewhere. A lot of business just paid people to do nothing. But by the way, that's what they do in Japan all the time to cover over deflation and stuff. So I think you've already seen most of the recovery, even when the vaccine maybe starts to work increasingly. Let's say you do get something like herd immunity at best, and that's when I might be able to come to Australia. Okay, that's a long time between now and then. I think the economy is going to collapse before then. I think it's ready to collapse now, and I love Jeremy Grantham finally have somebody agreeing with me on that this bubble just can't go much further no matter what they do, because it's just hit that diminishing returns point and that euphoria point where everybody's going to invest is in, and then it turns the other way and there's no way to stop it. So I think that this is an illusion by the markets on crack. Markets are always going to look for the reason to go up. They'll go down for a week and they'll say, oh, but it's really good because, they're going to have to print more money or something's going to happen. No, that's not what happens. You have to pay the piper at some point. The point I'm trying to make, and we haven't seen it yet, and when we see it, it'll become obvious. If we see it, and I do think we're going to see it, when deflation really sets in, it's this spiral you can't stop. Okay, debts start to fail, and then businesses start to fail, and that causes banks start to fail, and they both lay off people, and then people spend less, and then that causes more businesses and banks and loans. That's what happened in the 30s. This thing spiraled down so quick. That's how 62, now that's a fact, 62% of private debt, right out of Dalio's chart, disappeared in a matter of most of that in a few years. And how do you fight that with inflation? There is no inflation to fight that. There is no money printing. There's no trick to fight that. Once that avalanche starts happening, see, Everything's been to keep that up. Don't let the market go down too much. Don't let the economy slow too much. And they were really heroic on this. It's all to keep the avalanche from starting. Once it starts, and I'm just suggesting this, we'll see if it's right later. Once it starts, I say there's no stopping it. And then deflation will be everything Jim and I have been talking about. It's the people should fear deflation more than inflation. Hyperinflation and deflation are the two worst scenarios, not high inflation like in the 70s or modest inflation.
Harry has a very truncated view of the Great Depression. A lot of what he just described is an accurate description of the period from 1929 to 1932. The stock market did go down 89.2%. There was 25% unemployment, massive debt. So Harry's right about that, bank failures, et cetera. What is missing in the middle of the Great Depression, gold went up 75%. It went up from $20 an ounce to $35 an ounce. Gold was your best performing asset. Homestake mining was the best performing asset on the New York Stock Exchange in the middle of the Great Depression. And we had two technical recessions in the Great Depression. If you say Great Depression, 1929 to 1940, I think that's generally accepted. We had two recessions, 1929 to 1933, and then again, 1937 and 1938. But the period from 1933 to 1936 was a period of high growth. 1933 was one of the best years in the history of the stock market, but that's because FDR devalued the dollar and the gold went up 75% from $20 an ounce to $35 an ounce. So you can have inflation and you can have growth in the middle of a depression, but you do it by raising the price of gold.
Thanks, Jim. Now, Jim.
One thing, Greg, real quick. This is important to understand. We've already been in this depression phase. They've been fighting it with money printing. I'm saying the depression's going to be over in 2 to 3 years. I say, I agree, gold will come out of this strong and gold will boom for a long time into the next 30-year cycle, into the whole growth of Asia. So I'm just saying the next 2 to 3 years is going to be the backside 29 to 32 instead of the front side. We already had the front side GFC, like the 37, 38. That's the difference. This thing's going to be over. The demographics get better after that in a lot of countries. And gold will be a huge beneficiary of clearing out this debt and growing again, especially because Asia is going to be the big growth area, and Asians love gold.
Jim,
I'm not saying
it's really a mistake. It's really a mistake to talk about Asia. I've been there. It's a big place. I think you will see a bullish case and you will see growth in India and certain parts of Southeast Asia. China will be.
That's what I said.
Well, no, you said
what I said before. Southeast Asia and India is no longer going to be Chinese.
I said that. You said Asia. You said Asia is going to be a growth period. I said no. India and Southeast Asia, yes. China and Japan, no. So you can't generalize about Asia.
Jim, you've said that gold will reach 15,000 US an ounce in the coming years. I saw that on video.
Yep.
Today, it's about 1,800. So what's your forecast now? Is 15,000 a bit far-fetched in the coming years?
No, it sounds far-fetched, but it isn't really, because again, I like to stick to 6th grade math. Here's what people don't understand. So let's just take 2,000 for a round number. I know it's 1,800 and I know that's, a little bit away, but just take 2,000 for a round number. To get from $2,000 an ounce to $3,000 an ounce is a 50% increase. That's a big jump. That's a high hurdle. But to get from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. That's like 1 week's volatility. What people miss is they focus on the $1,000 an ounce. And yeah, that's a big deal. If you have an ounce of gold or 100 ounces of gold or whatever, if you have an ounce of gold and it's up $1,000 an ounce, you made $1,000. So that's real money. Good for you. But the point is, as you get to progressively higher levels, the same dollar increase is a smaller percentage increase because the denominator is larger. So unless you want to compute it logarithmically. So the point is, right now, getting from 2,000 to 3,000, that's, again, you got to be a high jumper. But as you get to higher levels, each $1,000 increment is going to be easier than the one before. Going from 3 to 4 is a 33% gain. Going from 4 to 5 is a 25% gain. Going from 14 to 15 is only a 7% gain. In other words, what happens is it starts out slowly, but then it goes hyperbolic. Those gains come very easily at the end because they're smaller. It's the same $1,000, but they're smaller percentage gains. So that's why the curve steepens dramatically. All the more reason to get in now when those big gains are ahead of you. Don't jump in at 14,000 and catch the tail end.
Harry, what's your thoughts of the future of
I'll
gold?
say the same thing I've said before. It's impossible to create high inflation. The demographics and high debt all argue for low inflation to deflation in the years ahead. I don't see how you create enough inflation to get gold to 12 to 15,000. Now, what I would see is possible, what Jim said, if the collapse was severe enough, which I do see, by the way, obviously, is that if people say, well, wait a minute, we got to have some standard here, and it ain't going to be Bitcoin. Maybe 10, 20 years, it ain't going to be Bitcoin, okay? It's the most volatile asset on earth. And by the way, gold's almost as volatile as stock, so it's not a stable asset in these days either. But if they came to the conclusion, we got to have a standard for now, and gold became it, then that would be the case for gold going up for some period of time. But that's going to come at the end of the crash. I'm trying to protect people here. I'm just going to be really honest. For the next 2 to 3 years, what I call the crash of a lifetime, on a 90-year cycle that's the most potent, you got to get through this, preserve your assets. And if you're in deflation-friendly investments like long-term treasuries, stuff, you can make money to have more money to invest at bargain prices in the best places. And it will. I'm sorry, I did say before, crystal clear, China's done. East Asia's had its boom. It is Southeast Asia and India. There's more people in that part of Asia than the others. And it doesn't mean the other ones go bankrupt. They just don't grow as much. So you can still have, Asia is going to dominate the economy. I'll stand by that one because that's pure demographics. US is plateauing, Europe is dying, East Asia is dying as fast as Europe, including China. China's going to go from 1.4 some billion down to 1 billion by the end of this century. So even China's going to be deflating. So I don't say you create high inflation, but if gold became a standard again, that would be a reason.
No, but Harry, you go from declining population to deflation without pausing for breath. How does a declining workforce? How is a declining workforce deflationary? That's inflationary because you're going to have to pay higher wages to get fewer people to do the jobs.
No, because people are spending less money. They're less productive. Productivity rises into the early 40s. Spending rises in the mid to late 40s and early 50s if you're more wealthy. Those things create, rising trends in money velocity and stuff like that. It's called
inflation.
Workforce growth means fewer people earning money and fewer people spending as much money.
I mean, workforce growth
slows because people get older.
Now, Harry, come on.
And work less.
Harry,
so I'm just telling you, Jim, this is 100%. My best indicators, my inflation indicator, it is workforce growth. And negative workforce growth would be deflationary. Now we'll test it out.
Why? If you have a negative workforce growth, you have to pay more people to show up. They get higher wages.
Not when people are spending less money because you're in a depression with 25%.
You just said they're spending more money. I mean, the older demographic, people don't save when they're 80. They spend what they have. So the older demographic means just saving, more money spending.
But they have less.
Let me finish. And a smaller workforce means you have to pay people more because you don't have as many people, so they can demand higher wages. So I agree.
Not if there's fewer people spending money.
We just said there's more people spending money. They're just older. They're 80-year-old. They're 80 years old.
People spending money right now is the government's giving it to them, and rich people are getting.
I'm not talking about
bonanza.
No.
Until that stops, people not. Now, I'm not talking forever, but it is true.
It's not making sense, Harry. It's just not making sense.
Everywhere in the world, even in the high growth rates like India.
I said that growth was going to slow. We agree on that. The population is going to go down and growth is going to slow, and that's going to be inflationary because wages are going to go up. And if you have higher wages and less output, then that's almost the definition of inflation.
Look, my next question is going to start with you, Jim. And because Bitcoin and cryptocurrency is a big subject at the moment, and over the last 12 months, we've seen enormous growth, and Bitcoin's last night reaching 50,000. We're seeing companies like Tesla, Facebook, Apple, PayPal, large life insurance companies joining in on this asset class. Jim, Bitcoin, cryptocurrency, this subject is becoming the elephant in the room. Will Bitcoin hurt gold? You have mentioned over the last year that Bitcoin and cryptocurrencies are not sustainable. You said it will hit the brick wall. You have painted a very great picture for this currency. Do you still believe this?
Yeah, I mean, Bitcoin is basically garbage. If you want to buy it, knock yourself out. But it's junk. Now you can say, well, why is it going up? Well, it's like any other bubble. Just look at the chart. It looks like every other bubble. It looks like the Nikkei in 1989. It looks like the Nasdaq in 1999. It just says bubble dynamics. But what people don't understand is the extent of the fraud in the Bitcoin price. A couple of things. First of all, gold, Bitcoin's trivial relative to gold. There's about 1 trillion of market cap in Bitcoin versus $24 trillion of market cap in gold. So that's not counting gold miners and paper gold and other forms of gold, et cetera. So it's the market's tiny. But here's what's driving Bitcoin. There's something called Tether. Tether was just basically there was a settlement yesterday with the New York State Attorney General where Tether admitted fraud, paid a fine. But here's what's going on with Tether. So Tether says they call themselves a stable coin, meaning you give them $1, they give you a tether, and they say 1 tether equals $1. Okay, so so you get your tether. Why do people want the tether? Well, they're using it in exchanges, not some of the couple of the more reputable exchanges, which do not accept Tether, by the way. But there are all kinds of exchanges around the world that don't have any money laundering rules, don't have know your customer rules, are not regulated, et cetera. And people are using the Tether to go buy Bitcoin. Sometimes they offer leverage, et cetera, and they're bidding up the price of Bitcoin. Now, just to kind of take that in reverse. So what happens when people want to sell the Bitcoin for Tether and then cash in the Tether for the dollars? Where are the dollars? There's no evidence that they have the dollars. In fact, they don't. They just kind of print Tether as it goes along. This is the greatest Ponzi in history. It makes Bernie Madoff look like a prudent banker. People are too naive to understand what's going on. This is happening in, I don't know, teenagers in Africa on cell phones or whatever, or Asia, or probably millennials in the United States, et cetera. But the point is, it's not worth anything. I tried buying a cup of coffee with Bitcoin. You can't do it. And there used to be one coffee shop in Brooklyn they always pointed to. They said, you can go buy coffee there, but I think it's boarded up now. So you can't spend it. It's an open-ended speculation. If you like it, go for it, be my guest. But it's a fantastic Ponzi scheme being driven by the fraud in Tether. And if you want to buy Bitcoin, do your homework and study what's going on in Tether. Look at where the Bitcoin purchases come from. They come from Tether. They don't come from hard dollars. And Tether says they take the hard dollars and they back it up, but they've never shown their bank account. They claim to have more dollars and their bank is in the Bahamas, but the number they claim, which has never been audited and never been visible, is greater than the combined dollar banking assets of the total Bahamian banking system by a factor of 10. So you tell me where the dollars are. They're long gone. They're being skimmed off by the billions, and these people are going to be left hung out to dry. So as we say in New Jersey, enjoy.
Well, Jim, you've taken a machete to the Bitcoin. I love it. Okay, Harry, what are your thoughts?
I'm down here with a bunch of crypto people in Puerto Rico, for obvious reasons. They love paying no taxes on super high short-term gains in, like you say, a speculative kind of Ponzi-like thing. The insiders say, and this is what I see as potential, but not proven, the play in Bitcoin, it's never going to produce anything. You buy stuff with it, it's kind of stupid, is to build it up, like Jim was saying earlier, if gold could get up to a certain level of value, it could be a backing for currencies, okay? They want Bitcoin to replace gold as a backing for currencies, and it has to get accepted enough. It's only at 2%, 3% US adoption and 1% global. So it could get a lot more, and they fixed the price to kind of force that, which is kind of weird, but that's what they're doing. They want it to become accepted enough that it can become a standard, and Bitcoin could become worth 10 or $20 trillion and rival gold in that. And by the way, I got numbers more like 11 trillion on gold, and it is right about 1 trillion. I may be wrong about gold, but that's what I got. Blockchain is different. Blockchain actually is software that deals with financial assets in the real world of internet and stuff, and that has potential, but none of these companies are profitable like the .com. So that's why I think Bitcoin is going to collapse. It may or may not survive and become that standard, but that's the game. It's not to say Bitcoin, and anybody I know that in the Bitcoin, they think it's going to go up forever to $1 million. They wouldn't dare buy anything with it, even if you could, because the great story in the crypto community is the guy that bought the first pizza on it, and it cost him $42 million. 3 years later. So it is kind of insane, but it is an early stage industry. Now, I do think real quick, gold should be performing. Even I was predicting it would go up to $2,200 in the early stage of this crash. It is underperforming, and it's because of a misperception. As I said earlier, I think gold investors think money printing does automatically create inflation, like Milton Friedman kind of thing. And then when inflation didn't come, that's why gold had its first crash. There's the perception that Bitcoin is an inflation. I literally listened to Paul Tudor Jones at the Tony Robbins Platt conference I speak at every year. Come and say he is buying Bitcoin as an inflation hedge. I'm like, what? It's not an inflation hedge. Gold is a legitimate, and even commodities and real estate are inflation at hard assets. It is not an inflation hedge, but there is that perception. And I hear more and more people on CNBC, oh yeah, we're using this as an inflation hedge, which means they're substituting it for gold. That is an error. And that is another reason I think Bitcoin's going to go down 95% before we see if it survives or not. If it does survive, and Ethereum and some of the more real companies like blockchain, I would consider investing them as new tech companies. But Bitcoin is a huge question mark, but it's not about producing something. It is about becoming a standard that's unproven. It could happen. I could see it happening, but it is unproven.
Yeah, I mean, blockchain technology has been around since the 1980s. It's kind of boring, but it has nothing to do with so-called cryptocurrencies. And by the way, this idea, I hear it a lot, Bitcoin will replace the dollar as the global reserve asset, all that stuff. It's nonsense. What people don't understand is that currencies are not global reserve assets. The assets are securities denominated in a currency. So you go to China, they have $1.4 trillion in treasury notes and bills. And they do, but they don't have pallets of dollars, printed dollars stacked up in the basement of the People's Bank of China. They have securities, which, by the way, are in digital form. The original cryptocurrency is the US dollar. It hasn't been issued, treasury securities haven't been issued in paper form since 1980. So it's a completely digital ledger. The message traffic is encrypted. So your dollar is your best cryptocurrency. But the reason that Bitcoin will never be a reserve asset, it's not because there's no form of money there. I guess you can say Bitcoin's a form of money. It's because there's no bond market. There's no Bitcoin bond market. There are no securities to invest in, and there never will be. And here's why. Because the reason people say it's an inflation hedge is because the amount of Bitcoin is capped, which shows that really good applied mathematicians and developers don't understand anything about monetary economics, because your economy keeps growing. Now, the complaint about central banks is that they grow the money faster than the economy, and that's a legitimate complaint. But you at least have to grow the money supply to keep pace with the economy. If you don't, then each unit of money, and Bitcoin's capped at, I think, 21 million coins. We're getting there. We're never going to get to 21 million because you need more electric power than the sun to mine the last Bitcoin. So you're going to run out of new Bitcoin sooner than later. But if the amount of currency is fixed and the economy keeps going up, each unit of currency buys more and more goods. And that's why they think that the value is going to go up, and it has so far. But here's the point. Why would that's deflationary. When the value of money goes up, that's deflationary. Why would you borrow money in a deflationary currency? You would owe more than you borrowed. Borrowers love inflationary currencies because they get to pay back less. Now, in a perfect world, there'd be no inflation or deflation, but you're never going to have a Bitcoin bond market because you're never going to have a borrower dumb enough to borrow in a currency that only goes up. And if you don't have the securities market, you're not going to have a reserve currency. So again, it's gambling. I prefer roulette because you get a nice drink and you can enjoy the ambiance, but it's kind of a joke.
Okay, gentlemen, thank you for your views. I'm just going to ask Jim for you just to give your closing remarks, and Harry will take on after that. And Jim, can you say to us as you're signing off, does gold still win?
Well, actually, gold never wins or loses because it's an element, it's atomic number 79. It is what it is. If you have a gold coin and you put it in a drawer and you go away for a year and you come back and open the drawer, you got one gold coin. It didn't multiply itself. So what happens is the dollar price of gold goes up or it goes down. You got different forecasts. But when that happens, nothing happens to gold. It tells you something about the dollar. It's kind of like when you have a patient, the first thing a diagnostician or a doctor does is you take the patient's temperature. And you stick a thermometer in your mouth, and now you just kind of scan your forehead or whatever. But you take the patient's temperature to see if they're sick. And the dollar price of gold is the temperature of the dollar. So when the dollar price of gold goes up, all that's really nothing's happening to gold. It's just the dollar is getting weaker. When the dollar price of gold goes down, nothing's happening to gold. It's just that the dollar is getting stronger. So fluctuation in the dollar price of gold really tells you more about the dollar than it does about gold. And so if you say to me, is gold going to win? Yeah, gold's going to win a lot. But what it really means is the dollar is going to collapse. So $10,000 gold, and that is my forecast. I think it actually will be higher, but I'm comfortable saying $10,000 gold or higher. That's my forecast. That's not a big win if you're a gold holder, because what really happened was the value of the dollar collapsed. But the reason to have gold is because it protects all of your other assets. In the world of $10,000 gold is the world where everything else has crashed. And so the gold will preserve your wealth. So yeah, gold's going to go up a lot. It's going to go up a lot for the reasons I mentioned. I've never seen a debate where Harry and I agree on everything except the outcome. We agree on demographics. We agree on declining workforce. We agree on lower productivity and lower growth. Some countries will do better than others. I think India is going to be a winner. I think we agree on that. Harry and I agree on a lot of things. The one thing we don't agree on is the one thing where all the science, history, and mathematics support me, which is that when you have a reduced workforce, you get higher wages, and that's inflationary, and that's going to drive the price of gold much higher.
Thank you, Jim. Thank you for being with us. Much appreciated. It was a wonderful debate, and we'll see you another time. I'm just going to cross to Harry now. Harry, to close off and move on to the rest of the program. Over to you.
You know, I think the most important point of this debate and why I like it, and I was looking forward to it, because I mean, I have debated a lot of gold and inflation, people that have that view of where things are going. And what I don't like about it is it's like a religion, you know, it's not facts and stuff. So I feel like Jim has that view. He's not a religion. He's just looking at it from a logical point of view and saying, here's how this could work out. What's important here is we have something here. Yes, we've had 90-year super bubble before. Yeah, we've had demographic booms, but we've had all these things. We've never seen governments, central banks in particular, hijack the economy and take over the free market system. They took it over. They set short-term rates and long-term rates, and all risk assets are set against that 10-year treasury bond, real estate, stocks, everything. It's crazy that they've done this. And so I look at it and say, well, okay, because of the financial asset bubble and the debt bubble, I know that when those fall apart on the private side, and that is all private stuff, most of it, that causes deflation. So that's what I'm looking to protect investors against and make money on. But I think the most important point again is this is unprecedented what's happened. There is no way to fully gauge this. And again, I'm sitting there I'm telling my own subscribers gold could go to 2,200 this year. And I'm having to back off because the Bitcoin investors are so stupid. They think it's gold, like gold. Now, stupid is stupid, okay? And I hate to say, a lot of gold investors have thought just because they're printing money, Jim doesn't say that, but a lot of gold investors think, oh, it's got to cause inflation, and it doesn't. So I'm looking at, listen to everything you've heard here today. Inflation, deflation, that is the most important. Booms and busts are easier. The difference between an inflationary crisis and a deflationary is harder to determine. They both happen in history, and they both favor very different investments. Bonds, good deflation; gold, good inflation, and a lot of other iterations. So as this unfolds, I already just changed my mind a little bit on gold short term by seeing how it plays out. And of course, I'm managing a fund in Australia now. What we're going to be looking for as this plays out, look at these arguments you've heard today. What caused inflation, deflation, and monetary velocity? And I'm big on money velocity, all this stuff. And as it plays out, you can shift and say, well, wait a minute. Is it playing more like this and the bonds are doing better? Or is it playing more, or something happening? And yes, like I do agree with, which is that if one of the outcomes was, my God, we have to have a standard, and the only one left is gold, and it's not the US dollar, and again, not even a chance on Bitcoin, by the way, but that would change things, and I would react differently. Okay, so I think that's the way we all need to see this. We've laid out the types of things that can happen. And I'm telling you, you're not going to get this clear a layout because I've debated too many other people. I'm not going to mention names, but there's people I do nothing but fact correct because they're not looking at history and what actually happened. They're looking at ideology and something. And people love that. It's like, oh, if you print too much money, then you get punished by inflation and debase your currency and this happens. Okay, and that does happen, but it doesn't always happen. So that's the way I would walk away from this. We've heard a lot here today, and you're not going to hear much more than this. I'm just telling you because I've covered the whole field and listened to everybody and debate a lot of people. You've heard, I think, the best two sides of this story from people that are into facts and logic and not ideology and making Bitcoin, talk about a religion. I'm down here in crypto land, okay? Bitcoin, a religion. And so you'll be able to play this better no matter how it comes. And that's the way I'm looking at it. I have my scenarios all the time, but I'm also changing them as this evolves because nobody's going to figure this out 100%. This is the doozy, the wild card of all history from what I can see. And I'm very happy to introduce Sean Allison. I've been touring with him until I couldn't last year for years now. He is our most popular speaker when we have these conferences and stuff. He is a very serious and accomplished trader in options. And you know what people think when they hear options? Oh, options. Oh, that's risky. Oh, that's crazy. They almost think like Bitcoin or something. No, smart people, the smartest money, use options to reduce risk because you can target them and limit your risk on both up and down and everything. So the key is in a time like this, and what have you heard today? You've heard two people say you're going to see one way or the other, inflation or deflation, boom, bust. You're going to see a lot of volatility in the years ahead. This isn't going to be like the 80s or the 90s and certainly not the 50s and 60s, a stable, booming economy. One of the things you can do is allocate some of your assets to a trading system that can do well in up or down markets, inflation or deflation, because it is a system that's proven and has a track record and that sort of thing. So all I know is Sean is our most popular speaker in the investment arena. People are happy. I've never heard anybody unhappy with his service. And so I beg you to stay and listen to him. And again, get a view of, how can options be used and see that this is not, it is a higher return potential, but it's not a high risky roller coaster type of system. The whole point of the system is to get higher returns without as high a risk. And Sean is very good at that. So with that, I open it up to Sean. Welcome, Sean.